Hello friends, I hope you're all well. Thank you for watching my previous 18 videos on equity investing. And as some people have suggested, demanded, I'm very soon going to continue with that series, and I already have a schema of 30 additional videos that I would be gradually recording one by one. But I thought I would create a special video considering the state of equity markets that we all are currently encountering in light of the corona pandemic, and therefore I thought of creating a separate video, a one-off video to deal with this particular aspect and share my thoughts. Before I go further, I would like to give this disclaimer that the purpose of this video is to simply express my views about the current situation and what is that I am currently doing to protect my own portfolio and not to provide any recommendation of any investment or strategy. And I would request the viewers to use your own diligence and where required expert advice before you actually commit to any investment or funds. So the purpose of this video is more for education purpose and perhaps to caution viewers from the mistakes that often get committed during this crucial period. And I hope you look at this effort from that perspective. So very quickly, what is the impact of the corona pandemic on the markets? You have all already observed them, but very quickly I thought of summarizing them more in the form of loud thinking. So people have been very concerned about the spread of this coronavirus and the potential risks that it creates to life, particularly of the elderly and medically vulnerable. While the pandemic spreads very quickly, the vulnerable class of the society are more senior citizens and those with specific medical conditions. So therefore, luckily, unlike the Spanish flu, the incidence of death, even in those countries where deaths have been very high, has been in the range of 5 to 7%, and those which have been able to manage it very well between 1.5 to 2%. So the good thing is that unlike the Spanish flu or unlike SARS and MERS, those kind of situations, here luckily the death rate is relatively lower. However, the concern is about the disruption in economic activity, and therefore some countries were clearly mulling of this possibility that why not allow the economic activity to continue. Yes, there could be a higher death incidence, but at least there will not be an alarming economic situation. But obviously an economic will not thrive in very uncertain conditions. So therefore, good sense has prevailed there also. And therefore, lockdowns, more precautions have naturally been in order. Now, in this process, what has happened is there is a clear flight to safety. So money has moved into the America, to the dollar, to the US treasuries and government bonds, and of course, to a certain extent, to gold as well. But at the same time, it has also created pressures on emerging market currencies, like what we have seen in the context of Indian rupee. At the same time, one other thing which also happened in the month of March is that there was this agreement between Saudi Arabia and Russia. Saudi Arabia being part of OPEC and Russia not being a part of OPEC, but yet they had achieved this mutual agreement that none of them will increase production. However, that accord was not renewed when it was falling due by 31st of March 2020. And therefore, Saudi Arabia also increased its production, not to lose its own market share, plus because of its other domestic compulsions, and because of that, oil collapsed. Now, of course, there was this indication by President Trump that there will be a truce of a kind between Saudi Arabia and Russia, and then we have seen overnight surge in oil prices in the range of 25% or more. So it also created this casualty of flight of investment from Indian market and similar other emerging markets, and therefore the impact on the rupee. Also, in the context of India, there was this concern that how would India manage this pandemic considering very large population and very high concentration in slums in urban areas. But we can say generally that we have done quite well in spite of all the challenges and in spite of the recent episode that happened with Tablighi Jamaat, in the vicinity of Delhi in Nizamuddin. So basically, we have generally managed this pandemic quite well. Now, let's go to the next aspect of this. How have been the responses from different countries? So, the responses have been generally in the form of both fiscal stimulus as well as monetary easing, and monetary easing in the form of lower interest rates, bond buying programs, liquidity for banks, NBFCs, like what we have also seen in India, humanitarian relief, including direct credits to bank accounts of the downtrodden, free cylinders, ration in India, additional ration, and at the same time, lockdowns have also become absolutely necessary to prevent the further spread of the virus, as typically has happened in stage 3 and stage 4 of this pandemic. And expanding testing programs has also been something which has been resorted to in the rich countries, particularly in countries like Germany, where they have also rolled out testing of citizens who don't have any symptoms. So that has also been done to prevent mortality. And another thing that has also been done by countries is, particularly we have seen that in India, that there is a certain relief which is given to borrowers as well as to banks in terms of recognition of NPAs. So finally, world always lives on hope, and therefore what we hopefully should see is a gradual containment and then reduction in new cases. Gradually the growth rate will start falling, hopefully, which has also happened in some of the countries which have suffered from this pandemic. And then new cases gradually start tapering down. However, this may not mean that the death or the number of deaths start falling. In fact, the number of deaths may continue to rise for some more time, particularly because of those patients which have been identified earlier whose treatment was going on, and some of them may have unfortunately succumbed to the pandemic. Now, what we will also see is that over next 2 months, roughly, it could be 6 weeks, it could be 8 weeks, it could be 10 weeks, or it could be even shorter if we are lucky, that we may be able to put the worst part of the pandemic behind us, and containment and care would still be very important. So the lockdown may not be completely lifted. They may start lifting the lockdown in steps, and particularly those areas which are subjected to congregations they may continue to have lockdowns in those domains, which is absolutely natural and which is completely required for safety of citizens. Now let's talk about the economic disruptions. So what we have already seen is that the lockdown, stoppage of travel, closing down of companies, work from homes has all resulted in significant slowing of economies. And what we can anticipate is that, like 9/11 changed the air travel completely from security perspective, Corona is also likely to change travel and tourism industry for a significant time, and perhaps always, from a health and safety perspective. So we already started seeing that some of the hotels also started checking temperatures of people and prevent entry of people who may be already or who may have already succumbed to a coronavirus infection. So as we discussed earlier, the lockdowns may be only gradually lifted, not in one go, and therefore the slowing will continue, though gradually there will be a recovery, but the pace of the economic activity will be naturally on the slower side. Further, some of the fragile banks whose financial condition is not very good, or NBFCs, the shadow banks, so to say, may continue to remain under pressure, and that will also have some kind of impact on the credit delivery. Though central banks have done, whatever possible, and they will continue to do whatever required to ensure that the credit flow in the economy again, revives. So we'll have to watch that particular space. Now let us see how we can cope up with this situation. Particularly, this is what I am trying to do or implement. So first part of this is the mind management part. Why mind management is very important is because if we do not understand the dynamic of mind, this is the most vulnerable time, and we can actually make errors at this time, and therefore I thought of sharing some of those aspects. Now, what I see is that a significant part of the stock market fall is already behind us. Maybe some more, maybe ahead, but significant part is already done. The interest rate environment is clearly equity supportive, so that's one very good thing. And we can see that some stocks have already begun showing bottoming out process. Thus, having already coped with the worst part, we can now look for future with hope. And as the bad news gradually starts tapering down in a week or two, our confidence can surely go up gradually. And we clearly see that most countries are now acting with alacrity, though some late than others. Fortunately, in India, we have been very proactive, and that's definitely helped in containing the pandemic to a large extent. Some argue that because in India the testing has not been done widely, the numbers have not swollen. But at the same time, one very important thing which has been done by the government is that all the vulnerable sections have been tested. So people who have arrived from abroad, people who have been found to be already, diagnosed of this challenge, of this infection, and their close relatives have all been tested. Similarly, the risk of the spillover from them and where the typical areas where they may go and mingle. So those vulnerable sections have also been tested generally by and large, which is a good thing to do. And therefore, we can bring this pandemic under quicker control in India. Secondly, a large part of Indian population is very young. 65% of the population is 35 years or younger. Typically, vulnerability through this disease or through this infection is more for people who are beyond 50 and those who have special medical conditions. So generally, we will be able to bring it under control, and therefore, from a mind management perspective, we can be assured that generally things are going to fall in place. Of course, we have to take care and take the necessary care when we step out of the house, and that too we should do only sporadically just to meet our domestic requirements. That's it. So we need to stop worrying. We should be assured that things will be all right, though it is just a matter of time, because this worry quite often pushes us to take wrong decisions. And in fact, I would also urge you to stop viewing channels and posts which spread negativity. Quite often there could be an agenda behind it. Negativity creates fear, fear creates supply in the stock market. Similarly, sometimes the analysts cut targets, stock price targets for companies dramatically. There may be a solid reason behind it, I'm not saying no, but we don't have checks in place whether a certain call is being given for creating supply in the market, and there could be vested interests who may be out there to buy things that we are not aware. We don't have access to managements, whereas these analysts and big investors do have, and they know something which we may not know. And lastly, I would also say that engage yourself in more positive activities. For example, what is that I am doing right now? I am creating a number of videos to engage my mind more positively. Another area where we need to give attention is managing our own cash. So providing for all our expenses, EMIs for next 1 year, all the domestic needs, some kitty for contingency and emergency, and then deciding what is the pool that we have available for investing. Now, I would say that to be more conservative, you need to divide this pool over a period of 6 months or 26 weeks, and that will give you a number that you can start investing per week and stick to that plan, because while the whole situation may come under control in next 2 to 3 months, but economic bad news may continue beyond this quarter to the next quarter also. So therefore, we need to be more prepared that there may be vulnerable investors who may react to bad news and suddenly come into the market to sell, and it should not create any kind of impact on us, and therefore it will be useful if we divide our pool over 26 weeks. Rest of the amount which is surplus should be invested in liquid funds or time deposits so that we are not tempted with money in the bank account. So this is something that as a part of our discipline we also need to do. Coming to the equity strategies that I am trying to follow, my first principle is that this is the time to buy price, not quantity, particularly when I already have a significant equity exposure. Those who do not have significant equity exposure, they can think of buying in quantities, but surely I can't, because I already have a very high equity exposure and I would rather benefit from prices rather than buying quantities and committing significant amount of investment at this stage. There is no need for you to sell any stock in panic unless you have some other credible reasons to do so. Maybe based on your study, maybe based on the understanding of the industry, the pain that it is going to go through, and if that pain is going to linger for a long period of time, then yes, you could take a view that it's time to invest, rather to divest that particular stock and move somewhere else, which is fine, but generally there is no need to sell anything in panic. Personally, I prefer and I always follow the defensive investing technique, and therefore I prefer zero or low debt or high cash reserves companies to high debt companies, particularly because of my age, where just like at a personal level, I wouldn't like to carry any debt on my head. I would also not like to invest in companies which are highly indebted. People who are on the younger side may take a contrary view and say that, well, I'm willing to go for a high risk and high return kind of a scenario, and I don't mind putting money to work at this stage when certain stocks have collapsed under the worry of high debt. That could be a call that some of you can take, but I'm just sharing the way I'm approaching it right now. What I'm also trying to do aggressively is using switch opportunities, where I feel that there is a certain stock which may not have fallen as much as others, and there could be very good other companies which have fallen significantly more. I wouldn't mind booking some amount of gain or booking partly some kind of a loss if required, because I can always carry that forward and take a set off in the later years, and I could switch that money into stocks which are temptingly attractive, and I have done that quite aggressively over last 7-8 days because I clearly saw opportunities. I'm sure you will also be able to sense opportunities based on your own study. Also, this is a great time to buy stocks of holding companies. Holding companies are those companies which do not have any other activity, but they essentially invest in their group companies. Now, in severe bear markets, the discount to the NAV goes up significantly. So if the NAV is X, the price, which normally would be about 0.45x or sorry 0.55x with a 45% discount, or 0.5x, it may right now the discount may expand, and you may find that there are companies which are currently going on at 65% discount, 60% discount, 70% discount. So you may think of putting money there, because there you may have the advantage of gradually, as the market recovers, the discount may start shrinking, plus the NAV will go up. So you may have a dual benefit. So that is something you can think of. I prefer beaten down large caps to mid or small caps. because they would clearly recover faster. And once they recover faster and my wealth has again gone up, I can take a call of switching from large caps to mid or small caps. However, I would also hasten to add that many small caps would have been completely beaten out of shape right now. And if you have a good understanding of a particular business, or you have a solid reason to look at a particular small cap, don't hesitate. In fact, in my switching strategy, I have also switched partly from some large caps or mid caps to small caps, where I clearly have a good understanding of what their business model is and the valuation. So the other thing I would also mention is that look at the insider trading disclosures which are happening on the exchanges. So for example, if you look at the BSE website, which is very well organized and designed, if you actually input the name of a company, you would see on the left hand side various kinds of information about that company, including corporate announcements, board meetings, and one of the sections there is about insider trades. And if there are insiders themselves, or people from the promoters or some of their holding companies have started buying those shares, that gives you an additional comfort that your interest and their interest is completely aligned. So I would urge you to also have a look at that. Those of you who may be interested in investing in bonds, personally I am not, but for some of my relatives where stock investing or equity investing is not something which they would be comfortable with, and I help them managing their own investments pro bono, where bond exposures are required. Clearly interest rate environment is going to be favorable, but the challenge is going to be more from a fiscal deficit perspective. Particularly if oil prices rise internationally, it will also have a spillover in India in terms of fiscal deficit, and therefore we have to be more cautious and use opportunities for investing in bonds only when the yields have surged, rather than investing, without any awareness about the current bond yields and the price scenario. So we have to be very cautious there. Another thing I would also say is that if you're looking for safety, then those mutual fund schemes which invest in government bonds are a much better bet than those which invest in corporate bonds, unless their information memorandum clearly states that that investment is clearly going in AAA rated companies or companies a notch below, say AA plus kind of companies, then it may be worthwhile looking at corporate bonds. But otherwise, I would say that from a safety perspective, it's fallen, and also remain in liquid funds, so that we have the necessary flexibility and very limited or calculated exposure to risk. So friends, I would like to thank you for your kind attention, and very soon I'll be resuming my structured 30 additional videos on equity investing, dealing with one topic at a time. But I thought it was opportune to make a video which is based on the current situation and share my thoughts also. I would request you to share in the comment section whether you have liked the contents of this video. If you have some other thoughts that you are implementing, please share so that others will also benefit. Do subscribe to the channel. I also have a Marathi channel which some of you who are interested can have a look at it. And I really thank you for the patronage that you have extended. Thank you so much.